The European economy is slowing again. Germany reported very terrible second Q results. So the whole recovery in Europe is now tremendously in doubt. So the headline of this thing is the worst really behind us. I don't think it's behind us. But we have Selwyn to let us know whether it is or isn't. Come on, Selwyn.
Good morning, everybody. Thank you all for attending. I'm humbled by the size of the crowd, the enthusiasm of the responses, and I know they shut the doors here on Wednesday. A number of you are my personal guests, and I told you you could gate crash, and I'm thrilled to have you here as well. We've got a very big agenda and a very short time period, so I'm going to be moving fairly quickly through a macro view of where we are, and then a micro view of how you participate in what we believe is where we are. So the theme is gaining altitude. And when we look at the global economy, Europe, we think, is an exception to that. In the global economy, things are moving up, and specifically in the United States, you're going to be seeing why we're filled with enthusiasm about things that are about to happen and are already happening. And of course, everything I say is always couched in the fact that there could be a black swan or two coming along that we could derail things, but it won't be a fundamental shift. It'll just be a postponement. The forces that are in place are very powerful, inexorable, and will not be set aside by anything, and you'll see some of them. In terms of the global and industrial context, bear in mind that we are in what we call the third industrial revolution. The first one was the invention of the steam engine, which I think you know about. The second one was the introduction of electricity, which was a game changer. And the third industrial revolution was the silicon chip invention, and we're still in the early stages of that. It is impacting every aspect of life, business, commerce, healthcare. There is nothing that is unaffected by it, and part of our enthusiasm is couched in that background. Now let's take a look at some of the indicators of health, and I'm focusing on the United States primarily because that's where I think the greatest opportunities lie, although we're not exclusively focused on that. But here it is. Facts are stubborn things, and you see home prices are rising again, and all of the statistics are showing a tremendous strength in home rising and in home building. Now, why does home building have to boom? Because if you take a look at this part over here, which hopefully this red thing will work, you see over here, this part over here was the overconstruction. And if you have excess inventory, then you know what happens to any commodity, including housing. Prices have to fall. And so the overconstruction in 2004, 5, 6, and 7 led to the collapse in 2008. But so long as we have underproduction of new housing units, we have to catch up because of housing formation. And so not only do we have evidence of it happening, which I showed you in the previous slide, but you see the reason why it has to happen. And housing, house building, home construction, home formation is a core generator of economic activity. It's also a measure of economic activity and health as well. Take a look at this game changer, which is the fracking explosion in the United States. Take a look at the oil production from Eagle Ford, which is one of the major ones, and from Bakken. Take a look at those numbers. These are extremely, extremely impressive numbers, and they have a huge impact on everything I'm about to talk about. All of these slides just support the fact that energy, natural gas, liquid natural gas, oil, are changing the entire economy of the United States and are resulting in, as you will see, onshoring, which is a word that was unheard of 3 or 4 years ago. Just to give you a sense of what the relative price differential is, we estimate that natural gas in the Chinese economy is about, we're about 1/5 of their price. Their price is about 5 times ours. In Europe, they're about 3 times ours. We're 1/3 the price of Europe. So you can see that heavy industrial manufacturing must come back and is coming back. Take a look at a short period. We just did a survey from January through March or April. Take a look at all of the manufacturing that's coming back into the United States. So it's all over. It's a huge, huge thing. The competitive advantage of China is declining significantly for many reasons, including the relative cost advantages of energy, but also productivity, largely fed by technology, robotics, and the silicon chip or technology revolution I alluded to earlier. Take a look at the increases in wages in China relative to the US, and you'll see what I'm talking about. The cost gap has plunged between China and the United States in terms of manufacturing. And so the US economy is back, big time. Now, it's not affecting Main Street, unfortunately, because there are some fundamental issues about how labor is employed, the use of robotics and technology, which ironically and sadly impacts employment. And so what you have is a two-speed economy. You have corporate America thriving, growing, doing really well, and Main Street suffering terribly. But we're off and running. And some of the reasons why are because 9 of the 10 top global brands are US brands. You'll recognize every one of them. People want to buy what we make. That's the bottom line. All around the world, they want to buy what we make. We own the brands. Take a look at all the Nobel Prizes that come to the United States. This is the seat of technology, of innovation. Take a look. These are powerful indicators of where we're headed. Now, I want to talk about some specifically interest rate and inflation related ideas. First of all, inflation is benign. There is virtually no inflation right now. And we're expecting very little inflation going forward. And I'm going to show you how you can find out what the market tells you. You see, people panic about vagueness and myth and anecdotal stuff. But there's actually a way to find out what's going on. And I'm going to show you right now in this slide. First of all, if you look at the top one, you'll see over here, we can tell what the market thinks inflation is likely to be. And here's how you do it. The 10-year Treasury currently pays 2.4%. You can also buy a 10-year Treasury that doesn't pay interest but just compensates you for inflation. That pays you 0.2% plus whatever inflation is expected to be. So we know, don't think, we don't project, we don't estimate, we know what the market thinks inflation is likely to be. It's the difference between the 2.4 and the 0.2. The difference is 2.2%. That's what the market tells you inflation is likely to be over the next 10 years. So for those of you who habitually drive down the road looking in the rearview mirror, which is what most investors do, not realizing that it's an early indicator of an impending catastrophe when you do that. But if you are willing not to drive down the road looking in the rearview mirror, you will see that inflation is benign and likely to stay benign indefinitely into the future. Not permanently, indefinitely into the future. So that's the first thing I want to set aside, the fears of inflation. Don't worry about it. Secondly, people think the market is overpriced. Now, there's no way to tell whether the market is overpriced because, you know, if you look at the market over long periods of time, it keeps going up. Just to give you my own sense, I came to this country with a funny accent in 1977. And at that point, the Dow Jones was, anybody guess what the Dow Jones was when I came here in 1977?
862.
Damn close, 850. Wow. Did you know that, or you just... Okay, very good guess, 850, okay. You know what it is today? It's close to 17,000. And if you add the dividends on those stocks, that ever-changing group of stocks, we estimate you'd be over 18 or 19,000. And if you included small and mid-cap, you'd probably be well over 20,000 on your $850 investment. Okay. The problem is, for those of you who can't handle volatility, there were probably a dozen times over that period where the market collapsed. Collapsed. So what? So what? You want a plane ride that's turbulent but will get you to a glorious destination, or you want to stay where you are? That's your choice. If I told you there was a plane ride that could get you to a glorious destination, guaranteed to arrive, but a lot of turbulence along the way, that's a very different story from staying where you are. Most people don't understand the difference between risk and volatility. I will submit to you that great equity investors understand that buying quality stocks is about experiencing volatility and no risk, as we define it. Risk being the possibility of permanent loss of capital. And I will distinguish, because it's a key difference as you change your religion from one of the people out there who thinks that bonds are secure and stocks are risky. And they've got it absolutely wrong. It's the stocks that are secure and will grow over time. And the bonds that are not just risky, but assuredly will lose you money. Assuredly. Let's take a look and see why we don't think stocks are overvalued. We only are concerned with one issue when we deal with stock overvaluation, and that is looking at this. Take a look at the S&P earnings yield, which is the blue line, versus the 10-year Treasury, which is the red line. The earnings yield is significantly higher than the 10-year Treasury. Now, the long-term trend is more or less a one-to-one, with some aberrations now and then. But certainly you're not seeing in this gap over here where you're earning more than twice, almost 3 times. The S&P 500 is earning almost 3 times what the 10-year Treasury is giving. That is very high by historical standards. You can, and if you think as an owner, as Buffettologists do, and we think of ourselves as Buffettologists, we certainly drink his words, read everything he says, and follow him very closely. Buffett views himself as an investor in businesses, not somebody manically trading pieces of paper, worrying about what's going to happen tomorrow or the day after. You know, the great quote is, when you're a quality equity investor, it's like watching a man walk up the stairs with a yo-yo in his hand. And the choice you have is whether you're going to watch the yo-yo or the feet. And if that doesn't resonate, then you should probably leave. Now, therefore, with a benign inflation, low interest rates, and all the fundamentals providing a huge tailwind, we're expecting for a Goldilocks economy to continue. That's not perfect, not ideal, plenty of things wrong. But the tailwinds are significantly stronger than the headwinds. Let's talk about why we're bullish specifically now and how we think that intelligent people can and should participate. First of all, it's happy birthday time, not just mine. It's actually happy birthday for the S&P 500. Just a few months ago, it celebrated the 5th anniversary of the low point in 2008. And over that period, it went up 300% from its low. While all the people out there, the geniuses, were sitting on the side absolutely convinced that the market was risky, that the economy sucks, that everything's about to collapse, and that they were holding their money under their mattress. And look how it cost them severely to be out of the market. Because the cost of being out of the market over long periods of time is infinitely higher than the gains, the possible losses of being in the market. Because if the stock market tends to move up over long periods of time, and history is on the side of the bulls, then you cannot risk being out, particularly since markets do not move up in a straight line. They move up in spurts, and if you miss those few days of spurts, you will never make them up. Long-term equities, take a look. This is by Professor Jeremy Siegel. Goes back to 1802. Take a look at that line. It beats bonds handily. It beats treasury bills. It beats gold, of course, hands down. And of course, the dollar shrinks because of inflation. So equities over long periods of time do really, really well, provided that you can handle the bumps along the way. Let's take a look at a more specific and more recent. This goes from 1926 to 2013. I hope you can see what happens to $1 over long periods of time, provided that you do absolutely nothing. That's the key. Position your portfolio, reposition your portfolio, rebalance your portfolio, reallocate your portfolio as necessary, but don't dance around buying, selling frenetically. Be a strategic investor, and you will see how handsomely you were rewarded. Take a look at equities at the top 2 blue lines versus bonds, inflation, and treasury bills, and you'll see that equities do really well. Bonds are only there for 2 reasons. To mute portfolio volatility for those people who can't handle the bumpiness, the chickens and wussies we call them, and also for people who need money for short or intermediate needs. The real risk of equities is you may need to sell, or you may want to sell, you may be driven to sell by your impulses, which is your biggest enemy, by the way, is your own impulse. You may be driven to do that at an inopportune time. And if you're out of the market for the upswing, you obviously won't participate, and that will be a loss that is realized and represents manifest risk, not volatility. Here's every single downturn going back to 1926, all the way to 2013, and you'll see that in retrospect, every single downturn turned out to be nothing more than a pogo stick that bounced down and then bounced way up, way higher than it ever was. And you can see the length of every downturn, how long it took to get from peak to trough, and then the recovery, how long it took to get from trough to peak. And every one of these was way surpassed as the pogo stick jumped way up from its previous high point in the fullness of time, for those who were committed and understood how equity markets work. Just a statistic you might find interesting. The average length of a bull market is 108 months. The average length of a bear market is about 16 months. Most people don't think so, because the behavioral economics, the psychology of investing, tells us that people feel pain far more acutely than they experience the same amount of pleasure. So most people walking around think that bear markets are prevalent, common, and that in fact the market is pretty much even because the ups and the downs kind of weigh each other. Of course, that's simply not factual. This is the cost of what we call bad behavior. And I have some handouts at the end, you can pick them up, which talk about it. But bad behavior is simply the inability to suppress your urge. Because most people, we're all bred genetically from animals, from the wild kingdom. And in the wild kingdom, people basically animals herd together when they're feeling really comfortable and flee when they sense danger. So the flee mode, and if you ever go on safari, you'll see that. I'll come back to safari in just a moment. After all, I do come from South Africa. But the one thing you learn from the animals is they do exactly what does not work in the stock market. If you crowd around like animals do when they're feeling really comfortable and hang out with your buddies doing what they're doing, and then flee when you sense danger, you're probably going to be buying at the top and selling at the bottom, which is why most people have a terribly bad experience with the market, and I will show you in just a moment. But take a look at the cost of missing the best day, the best 5 days, the best 15 days, and so on. If you miss the best days, you'll never make them up. You can't afford to be out of the market for the risk that you'll miss these spurts that determine your whole portfolio performance. I want to talk about the real risks that you face. First of all, and these are real risks, not turbulence. Number one, market timing. Those people who believe they can pick the time to get in and get out. There's no evidence of anybody having a consistent ability to determine when to get in and when to get out. Stock picking. Absolutely no evidence that people can successfully pick stocks. If you think about how the pricing mechanism works, the pricing mechanism of the market takes all of the available, knowable, and known information, processes it through this machine called the market mechanism, and comes up with a price. And then you find people who are arrogant enough, stupid enough, or think you're stupid enough for you to believe that they can spot mispricings in the market. I will not even begin to tell you what I think of those people, except that I will generically refer to Wall Street as the red light district of Manhattan. Now, when we started saying that 8 years ago, people thought we were kind of kooks. Today, people don't think it's either funny or offensive. They know that it's the truth, because the Wall Street machine exists in a different orbit. And they're into the arrogance and the belief that you will believe them when they tell you that they have methodologies, systems, procedures, protocols to determine when stocks are underpriced. And I'm going to get back to that and show you how wrong they could be. The third mistake people make is they buy yesterday's winner. Now, for many, many complex reasons, including what's called reversion to the mean, which is the primary one, yesterday's winner is almost always tomorrow's loser. If you buy everything that did well yesterday, or last year, chances are you'll be picking the losers for next year. That's just the way it works, because of the cyclical nature of elements of the market. And I could show you tons of data on this. Everything I'm telling you is not original. Our job is not to generate original ideas, by the way. You're not going to hear anything from me that's original. Our job is to filter out what we call the noise from the news. And that's what I'm trying to bring you, is the real stuff. And finally, the excessive fees and charges. Now, John Bogle has a great quote. He says, "The magic of compound income is frequently offset by the tyranny of compound costs." And that's catastrophic for people. If you've got a partner who's sucking out 2 or 3% of your returns every year, there's no way you're going to get ahead of the game. That's just such a huge, huge impediment to performance, that the single thing you can control more than anything else is minimizing and controlling your fees. There are other things you can control. You can control your portfolio allocation. You can control your own bad behavior so you don't do stupid things. There are a lot of things you can control. You can control how your portfolio is allocated. That you can control. But the actual market you cannot control. You sit by and let it do its magic, which it does, and keep the costs and other fees low. Now, most of you have no idea what you're paying. because it's buried in fine print that you probably couldn't read unless you had a magnifying glass. And they call it multiple different things disclosed in multiple different places. There's no single place where they will tell you all the fees, costs, charges, management fees, sale charges, compliance charge. Every one of those is a different name, different label, disclosed in a different place. Many of them are buried deep under the net asset value. I have yet to meet a client who actually knew what they were paying, and who, when we lifted up the hood and told them, wasn't absolutely shocked to find out what they thought was a no-load fund was in fact a heavy fee charging account, and so on. And many of the constructed products, what we call the black box products of the Wall Street machine, are laden with fees and charges and costs which you will never find out about. Here's your bad behavior calculation, which I promised earlier. Over long periods of time, the index does somewhere between 9.5% and 11%. If you pick any of the major indexes, S&P 500, MSCI, Dow Jones, they all congregate at between 9.5%, 10%, roughly over long periods of time. Most individual investors earn 2.5%. You know why? Bad behavior. That's called the behavior gap. It's the difference between what the markets do and other people do. It's amazing to meet people who last year, 2013, the S&P 500 did 32%. Whichever index you picked would have done somewhere between 22 and 30% roughly. We had people coming in with 8%, 7%, 3%, and I'm saying, wow, that must have been difficult to achieve. Really difficult. You took a huge act of tenacity to actually manage to achieve low to mid single digits in a raging bull market. So, of course, you know, bouts of panic and euphoria are really a gift to patient, astute investors. Don't worry about it. Don't watch the stock every day. The most dangerous thing you can do is keep watching your equities every day, because it's going to promote you to react to your impulse. And your impulse will always lead you astray. That's the problem. In everything else, people rely on intuition and impulse. In the stock market, you need to suppress it. It's your biggest single enemy aside from your stockbroker. Now, much more money has been lost by investors preparing for corrections or anticipating corrections than is ever lost in the corrections themselves. And those of you who talk to your friends now know that. They're all waiting for the correction. They waited for the last 8,000, 9,000 points on the Dow. Well, I stood here almost every month for the last 6 years and said, guys, the market is in a solid bull run. How many of you remember me saying that? Every month when anybody asked me a question, I said, and everybody who gave me a chance, I said, don't blink, stay buckled in, bumpy ride, turbulent destination ahead. A glorious destination ahead with lots of turbulence along the way. And so far I've been right for the last, I don't know how many thousand points on the Dow. And we're still there. Stay buckled in, bumpy ride ahead, assured arrival at the glorious destination called financial independence. That's the glorious destination, because the two sweetest words in the English language are passive income. Now let's talk about all the reasons why you should never invest in the stock market. From 1934 to 2013, we listed every single year a reason why you should not have invested. And believe me, every single year from 1934 until now, there's been a fantastic reason why the market looked terrible, and why the very worst thing you could do is to put your money into that risky lottery, Las Vegas style investing vehicle. But I'm going to give you one reason why you should have invested. Because had you invested in 1934 and ignored all the nonsense that I just showed you on the previous page, your $10,000 would have grown to over $28 million, while your friends were sitting there with no nails left at the end of their fingers, worrying about everything and keeping their money in bonds, which of course you know what $10,000 of bonds would buy today. Here's a little wisdom from our primordial angel. That's our team arriving there. This year we go every year. That's our first part of our delegation arriving in Omaha. Just so you know, we actually do it. We take our clients every year. This is the private jet group, our major clients, and then of course people come commercial and so on. We have a pretty big delegation there every year, and it's an amazing experience. If you haven't gone to hear the sage and his right-hand man, it's worth going to listen to Warren Buffett and Charlie Munger. 6 hours on Saturday, and they banter about life, philosophy, economics, wisdom. Just a fantastic treat, highly recommended, and we go every year to get another sip of the Kool-Aid. Now, this is the arrogance of people who think they can figure out market timing. And this is a graphic that just shows you that what happens in the pricing mechanism is that all available information, known and knowable, is processed. Everything. The company's equity, its prospects, its earnings, its risks. And that processing system derives a price. Who among us has the guts to say that this entire system doesn't work, that the free market is not going to determine a fair price, and then act on that? I'd be fascinated to see anybody who would do that. Certainly we don't. I can tell you, we don't think there's any room for that at all. So now I want to talk about how most people get their information. You will remember that in 1978, at the very dip, the worst time of the market, Business Week came out with perhaps its most famous or infamous cover called The Death of Equities. Had you bought equities on the day that that came out, you would have participated in the most dramatic run-up of equities in American history. That was the day to buy. So here they call the market bottom brilliantly, right? Except they thought it was a top. Now, take a look at this one, house flipping houses for dummies. This was issued at the top of the housing market. At the very top. If you bought this in 2008, when it came out, and acted on exactly what they told you, you would have been the dummy. So they were right. They just didn't realize that house flipping was for dummies. That's not what they meant, though. Let's take a look at a couple more. Here's another one. Business Week, the fall of an American icon. This is 1996. The price then was $6 a share for Apple. Okay, this is where you are probably getting much of your information from. This is another one, April 2004. This is a classic from Money Magazine, which people read as if it was the Bible. April 2004, why iPod can't save Apple. It had gone from 6 to 14 by then, already more than doubled. And again, the magazines are still absolutely convinced that Apple's on its way out. Let's take a look at another one. Fortune, is Google over? This is the source of your information, ladies and gentlemen. Let's just go through it. Now, I want to show you Coca-Cola because it's a very interesting one. It was Fortune magazine which showed you that Coca-Cola was the #1 most desired company in Fortune's entire list. And I want to show you how wrong you could have gone had you followed that piece of advice from Fortune. Here's Coca-Cola. The red line over here is the S&P 500 and the blue line is Coca-Cola. Following on from the advice of Fortune magazine, no less. Let's take a look at this. Until 6 years ago, look what they're saying about Coca-Cola. They couldn't pan it enough. Now, this was the #1 selection of a respected magazine like Fortune, no less. Here it is. Couldn't begin to pan it enough. Now, let's take a look at how one accesses quality stock, because that's really what it's about. It's not about stock picking. It's not about market timing. It's about strategic deployment of wealth into the market in an intelligent and prudent manner. So, the most famous index that you know about is the S&P 500, right? And everybody thinks that's terrific. And of course, even that will beat 80% of active managers over any 10-year period historically. Even that. But of course, there are problems with the S&P 500, and most of you know the problem because it was manifest after the tech bubble. After the tech bubble, the Dow Jones, the S&P took a big hit, and it took basically a decade to come back. And why? Because it is a cap-weighted index, so that the in favor and overpriced stocks have the greatest component of what you're buying. You're always overweighted, definitionally, in the overweighted, overpriced, and in favor because they have the highest capitalizations. And you're underweighted in the underpriced, overlooked, and undervalued companies. Now, obviously, you should understand as an intelligent investor, that's not what you want to do. So how do you overcome that? And by the way, just to give you a sense of the disproportionate weighting of the S&P 500, 50% of your money in the S&P 500 is allocated to the largest 50 companies. And the smallest 50 companies get around 2% of your money. So you're not so well diversified at all. Not only are you not well diversified, but you're most susceptible to the collapse of bubbles. And therefore, there are many other indexes that are created that we believe are significantly superior. By the way, one of the problems with the S&P 500 is that the components are selected by committee. And we don't have that much respect for individuals making stock selections, as you already know. It's a problem with the S&P 500. So there are, what I would suggest to you are better approaches to accessing great companies. There is what's called enhanced indexing. called smart beta, or the word we own is called IntelliBeta, which is how do you access beta, which is market returns, and then optimize those returns by tilting, overweighting in factors that we know are likely to produce superior returns over the long term based on history. So let's talk about some of them, and I'll give you just a brief education of the construction of indexes so you'll understand. Two other approaches other than capitalization weighted, which you should understand is simply not the way to pick stocks and allocate. You don't want to pick the most to the most highly priced. You wouldn't buy anything else that way. You wouldn't say I want most of the most expensive and least of the least expensive. It's contrary to everything you would shop for except for stocks. So fundamental equal weighted says we're not going to overweight this. We're going to pick companies, but we're going to equal weight them. So if you bought the S&P 500, you'd buy 1/500th of each of those with your money. And every quarter you'll rebalance so that anything that's gone up significantly gets sold down, and then you revert to your 1/500th. So you're always selling the overpriced and in favor, and buying the underpriced and overlooked. And it's a great contrarian strategy, and I will show you in a moment how it works. Fundamentally weighted is a far more intelligent approach than either of those. What it says is we're going to weight the companies in an index based on the economic fundamentals, the true economic footprint. We're going to measure things like sales, gross margins, cash flow, dividends, etc., the things that you would look at if you were buying a business. And the fact is, if you're going to be an equity investor, you should be looking at it as if you were buying a business. So let's take a look at these and see how they compare, and let's take a look at how you can construct a portfolio that is overweighted, always using indexing. So you're removing stock picking, you're removing market timing, and you're just going to access indexes. And let's take a look at some of the indexes that work. Now, what is it about enhanced indexing, before we get into the specifics, is right here that I wanted to point out. What we seek to do, and what I suggest humbly that you seek to do, is to do the following. Number one, you want to capture long-term market returns because we know that the market works over long periods of time based on 200 years of history. Now you want to enhance that return by tilting towards factors, overweighting towards factors that can show that they have, based on long-term trends and long-term analysis, that can tilt the portfolio towards factors that have historically delivered superior returns. And I'll give you some of those factors. Value stocks tend to outperform growth stocks over long periods of time. Smaller companies tend to outperform larger companies over long periods of time. Dividend payers tend to do very well. Quality companies, and the word moat. Now, Warren Buffett invented the word moat because he likes to buy companies that have economic moats around them, pretty much the way castles in Europe used to have moats around them. That means difficult for competitors to access your marketplace. So those are the kind of things we like to see. So let's take a look at some indexes and see how indexes are not created equal. So here's an example. Okay, this is called an equal weight versus a cap weighted S&P 500. You'll see that over this period, which is I think it's a 5-year period, 4-year period, went from 100% appreciation for the S&P 500, and the RSP, which happens to be an equal weighted index, went up 150%. That is an enormous difference, a 50% increase just by picking the right index. Take a look at this. This is the Barron's Index versus the S&P 500. Take a look at that. Huge difference. So you see over here that there is money sitting around that if you knew how to access superior indexes, you could do a whole lot better. This is fundamental indexing, which is the blue one, versus the Dow Jones and the S&P 500 over the same period. So you see, these are the kind of indexes that I was referring to earlier. Fundamental indexing, creating an index based on the economic fundamentals of the company you're buying. I told you previously that we're expecting and know that there is an industrial resurgence in the United States. You should therefore not be surprised to find that an index that is constructed solely of companies in the industrial sector has done significantly better than the S&P 500. Dividends. You can see the significant difference, outperformance of dividend-paying stocks versus non-dividend-paying stocks. Here's the quantification of costs. Most clients who come into us are paying around 3%. We bring that way down. But take a look at what happens in the difference between those paying 3%, probably not aware of it, and those paying 1%. So take a look at what happens over long periods of time. So you take a look at $1 million invested, take a look, grows to 7.6 as opposed to 5.7 and 4.3. So you see that the costs also compound, the differential also compounds. This is a massive difference that you lose and you're not even aware of it. So if you didn't know better and you retire with $4 million in your account, little do you know that had you fired your Wall Street type and hired or done yourself the management in an appropriate way and cut out that additional level of fees, you could have had a significant amount of additional money. People are just not aware of that enough. As I said to you before, bonds are used for very restricted purposes. As the old movie said, there's the good, the bad, and the ugly. And I think you're all aware of that. Anybody who looks back 10 or 20 years and looks at what $1 million was worth then versus $1 million now, you know that although you don't feel it and you don't write out a check every year, you will be devastated over time by inflation. You just will. That's simply what bonds do. But yet people are out there thinking that bonds are secure. They're a guaranteed loser over long periods of time. They only have one role, which is short to intermediate needs, and for those who can't handle the volatility of markets. So they work in exactly the opposite time frames. That's where you put them together. You see, bonds are very good for the short term. If you need to have money for a wedding or a house purchase or some big expense 1, 2, 3, 4 years from now, that's what you use a bond for. For long-term portfolio wealth building, there's no place in a portfolio for bond for those who can handle the ups and the relatively minor downs over long periods of equities. Take a look. There are many quality companies that are paying higher dividends than their bond yields. So why would you pick a bond when you can get more money on equities as a dividend? So this is just a brief thing on us. Our focus is the long-term well-being of every client. Our methodology is all evidence-based. It's basically harnessing the science of capital markets. Nobel Prize-winning economics is all put to use. Our perspective is, of course, that everything in your investment life takes place within a financial plan, within a context of who you are, your goals, your needs, your fears. And uniquely, our wealth team, every single member is a CPA, a registered investment advisor, and a personal financial planner. So we think, the tools necessary. Our lawyers make us put this up always. Not that anybody ever reads it, but the fact is, obviously, past performance is not indicative of likely future performance, and all the other stuff that you read at the bottom of everything that's put out. And that's the end. Thank you so much. It's been an honor to speak to you.